good morning. It's 11 o'clock. So we think we should get going because there's some stuff to get through now. So our guest this week is James Hart of Whittam. So it's going to be interesting to see what he's got to say about that fund, which is obviously quite a large generalist trust. News-wise, there's a few things to talk about. I'm going to start off with Aberdeen Latin American Income, which has not covered itself in glory since it launched. That's the full history of the trust there, from its launch in 2010 through to yesterday. And you can see that the discount opened up back in sort of 2014 and never really closed again. And obviously that constraint what happened to the fund. It's, as I say, it's been going since August 2010. It's a mix of equities and bonds to try and generate the income. So it's actually a sort of 60-40 trust. And as you know, 60-40 strategies have fallen out of favour quite heavily. It did say at the beginning that it would use buybacks to limit the discount to no more than 5%, which seems like a fairly strong promise. I think as the trust shrank, that became harder and harder to do, and they sort of gave up on that, which is why the discount has been as wide as it was. At the time when they launched it, it was proper top of the market stuff. And Latin America had come through the financial crisis relatively strongly. There was good demand for commodities. People were casting around for other ways of getting income because BP just cut its dividend and UK equity income funds were suffering. And all of the kind of emerging market and Asian income funds are trading on premiums. And I think Aberdeen thought, we've got an Asian income fund that's doing quite well. Let's launch the Latin American version. And this is from the prospectus. So, you know, and this is what I mean about top of the market stuff. Again and again, it's unfortunate, but people only really want to buy things when they've been doing quite well. And you can see there that it had Latin America been having quite a strong run. And the other thing was that, you know, they were saying inflation's dead. Unfortunately, it turned out not to be true. And earnings growth forecasts were amazing. It was all going to be wonderful and the best place to invest. And of course, they didn't really work out that way. Those are the figures. So over 10 years, both of these funds have actually lost you money on average every year, which is obviously not great. And that discount was a bit wider than that before they announced this news that they're just about to talk about. Returns wise, it has been pretty bad. So most years there, it's underperformed the benchmark, sometimes by quite a lot. I think the combination of poor performance, wide discount, you know, and the tiny size of it, it's no wonder really that the board said, let's give up. So they didn't raise enough at the beginning. They wanted 100 million, then got 52. They had some subscription shares that could have made it a bit bigger. They were only 1 for 10, but they didn't actually sort of come to anything. They did raise another 15 million in a C share. Again, they didn't raise as much money as they wanted, but nevertheless, it did help a bit. But what really killed it was the sort of taper tantrum in the States. And this happens again and again, basically. Whatever's going on in these emerging markets, if the US catches a cold or interest rates start going up, then they completely fall out of bed. And it's particularly true of Latin America. And so the rate rises recently have been very unhelpful. Because it's so small, the ongoing charges ratio is quite high. And City of London, who are an activist investor and do quite a bit, they're not maybe quite as aggressive as they used to be, I think. But nevertheless, they would have been saying, this is not good enough. And actually, when the announcement, the board said, we have talked to our largest shareholder and professional advisors. So basically, it must be City of London that said, just give up. So they are going to liquidate it. I think, you know, I've been pushing back against these things where they just liquidate them and there's no rollover option. But in this case, it seems to make sense because of the tiny size of it. There's not a lot of money to play with here. So the relative fees in trying to get something done in terms of a merger would have been quite difficult. And you can take your money. You're very unlikely to get any kind of capital gains tax triggered by this. And so therefore you can just go into the market and buy the equivalent BlackRock fund, which is much bigger. It's about 100 million quid. So I think that if you want to have Latin American exposure, that is the way forward. And at the back of my mind is this sort of feeling that probably this is bottom of the market stuff. If they've actually sort of put bands and surrendered, it might actually turn out to be quite a good time to invest, but we'll wait and see. Blackstone loan financing next. So this is one of these complicated, relatively complicated structured finance funds. So it invests in structured credit, where you take a portfolio of bonds and then you sell off interest to them and into different tranches. So at the top, the ones that get protected most from anything that goes on within the portfolio, you can get something that looks like it's got a AAA credit rating because it's got this huge cushion behind it. And as you go down the structure and you get to sort of equity tranche, they get a lot more income for that, but they also take the first risk if there's any defaults in the portfolio. And so those are sort of, these funds are investing in those kind of bottom end tranches of stuff. So it's important that therefore that the loan quality of the underlying CLOs, they're called collateralized loan obligations, is quite good. The discount on this widened out again. And again, it's not really approached asset value for a while now, despite a very, very high yield, as you can see here. So these things are trading on double-digit yields for the most part, but it's still on a 17% discount. And that really is, I guess, because investors fear that in the current environment, there are going to be losses in the portfolio and your capital is going to be eroded. That launched at €1, I think. So 90 cents now shows you there has been some capital erosion, but it's not enormous. Some of them have done a bit worse than that. Those are the returns, though, over the long term. We're not quite 10 years old on this. Has been relatively good recently, which is maybe one reason why the board want to keep it going. But they did say in January that they were going to talk to shareholders about measures to tackle its discount. And they have been out talking to more than just the big the largest shareholder. They've talked about 78% of the register. And what they've decided to do is nothing, which sounds a bit weak, but actually they have canvassed a lot of opinion and they just couldn't find consensus around what to do. So one thing is they're going to ask shareholders for permission to invest in new CLOs so that some of the money will get reinvested rather than returned. That's a slightly odd thing. It wouldn't have been what the thing I would have thought would sort out the discount, but no, there we go. And they're saying there's a possible continuation vote in 2024. I think that's a bit weak. I think they could have actually promised to do one and still tried to fix the discount in the meantime. And had they succeeded, then there wouldn't have been any need for a continuation vote. What you've got here is just sort of ongoing uncertainty, which is, I always think, a bit unhelpful. They're also saying that they might change the way the NAV is calculated. Now, I wasn't aware that they'd done this, but apparently after they launched, they did change it. So the way that the net asset value was calculated at the beginning was they took the market prices for the different bits of the CLOs and just translated that into the NAV, the way you would normally with like equity portfolio or something. At some point, they switched that to pricing it where it should be in theory. Kind of like if you had a dividend share, and it's supposed to sort of do this sort of gentle upward slope, and if you just price it along that the whole way, and just ignore the NAV thing, it doesn't. To me, it doesn't ring true. Anyway, so they're going back to doing it mark to market, which I think is probably good news. So we'll see about that. I do think there may have been some shareholders who've been stirred up at this, thinking that we're going to get their money back, and now would be a bit annoyed that it isn't going to happen, but we'll wait and see what happens. Now I'm going to hand over to Richard to talk about Epic.
Thanks, James. Yeah, so Ediston their board have launched a strategic review this week into their future, and it could result in many possibilities, but their preference is to merge with one or more of the other REITs, their peers, but it could also result in the sale of the company or their portfolio and return money back to shareholders. And this come about because it's been on a persistent wide discount to their NAV. It's 20% today. It's been around sort of it's been worse than that, but it's not really traded at par for a number of years. So which has meant it's not been able to grow, and which is frustrating for them, because they see, especially at the moment with valuations down, they see a lot of opportunities to buy properties and have decent returns on them going forward. So if we go on to the next slide, we see their sort of performance since they launched. So like I said, they've not been trading at par since sort of 2018. Really hit at the start of COVID. Retail properties and properties in general will sort of hit hard with tenants not being able to pay rent, especially retailers, with everything shut. But they did bounce back, and they're invested in the sector. They're invested in retail parks, which has a very different characteristics and supply and demand than shopping centres, things like that. So they did bounce back, but this is their performance. You see them towards the bottom here over 5 years, and that their values have been hit again at the end of last year after the sort of impact of interest rate rises and things like that. If we look at their peer group in the AIC UK commercial property sector, they're pretty small, 136 market cap, and there's a lot of small companies in this, and like I said, they prefer to do a bit of sort of consolidation with their peers. And that makes sense to me as well. I think I've written about it in the past as well. There's quite a lot of small cap REITs that are got very similar investment policies that could and probably should merge. But because they're so focused, they're 100% focused on retail parks, whereas most of the others are diversified. Not 100% sure where they would fit with others unless they wanted to increase their exposure in retail, which a lot of them, having spoken to them in recent months, don't. But there is another fund called New River REIT, which is not in this peer group, but they're focused on retail parks, and that may be a good synergy there, and where that could end up. But we'll have to wait and see what happens. It'll be interesting. And like I said, I think there's going to be more of this over the next sort of year or two, and there has been over the last previous 2 or 3 years. So yeah, we'll see what happens with that. It'd be a shame to see them go, though. I think they're a good company and good manager as well. So fingers crossed.
Cool, thanks, Rich. So as I sort of put up slightly early there, Scottish Mortgage is the other one, and I don't know whether all of you have seen this story yet, but basically there is a story in the FT this morning that's now up on our website too, and that one of the directors, this chap abrdn, has basically had a row with the rest of the board. It's not clear yet whether he's actually resigned, been dismissed, just got kicked out of the meeting. We're trying to clarify what's going on. We've asked Bailey Gifford for more comment, but it's basically around. It says basically that there was a dispute about hiring policy. They're trying to hire 2 new directors, and we didn't go into the details of that, or what the problem was. But also, he's questioned Bailey Gifford's ability to manage its unquoted portfolio in more difficult times, basically sort of implying that it's been riding the good times and will struggle now that the capital constraints and within the sector and general sort of valuation declines in that sort of venture type area. So it's quite a sort of big row. It's not sort of thing we normally see. It's definitely not normal to go running to a journalist the minute the board meeting ends. And we do need to wait and see what really happened here, but I don't think that Bailey, well, it comes down to the right people in the right place, but in terms of resources and numbers of people, there isn't a problem. There are 51 partners at Bailey Gifford. There are well over 1,700 staff working there. I know they're not all investment professionals, but there's still a lot of investment professionals. They've got offices all around the world. I don't think there's any shortage of people. We don't know, though, because we only get to see the portfolio managers, whether they've got this sort of in-depth specialist resource to cope with unquoted or not. But I would have thought that they do. And if they don't, then that they could sort that out. So I'm not sure that it is an issue. It's definitely going to sort of make the front pages for a while. There is, though, this ongoing problem with the size of their unquoted portfolio. So they've got a hard limit of 30%. I think Andrew said this morning it's 27%. So at that sort of level, they've got to be really careful about whether they can spend more money on it or not. And as these things start to run out of cash, they're going to be knocking on the door saying, please give me some more money. If Baillie Gifford can't follow on in its investment because it's prohibited from making additional investments in the unquoted, which it would be if it breached 30%, then it can find itself seriously diluted, and that would be quite destructive of NAV. So we don't want that to happen, and I would like them to get this sorted out and come back to shareholders and ask to lift that limit on a kind of temporary basis. But we just have to wait and see whether they do that or not. So there's that. Nobody's asking questions about it, so it's good. We shall move on, and let's talk to James.